So hello all my dear students, I hope you all are doing good. So I welcome you all to our second revision video of CA Final Direct Tax May 23, November 23, which is going to be in full English, mainly benefiting the southern part of our country, our South India students. Okay, so without wasting any further time, let's start with the second revision video. The first thing which we are going to do in this topic is taxation of various entities, where we are going to talk about all small entities, their taxability, their tax rates and their special provisions. Okay. So the first thing that we are starting today is the taxation of cooperative society. Let's see the tax rate of cooperative society. A cooperative society is not liable to tax, on every rupee. They do not get any basic exemption limit like an individual gets. So up to 10,000 they have to pay a tax of 10%. About 10,000 they have to pay tax of 20%, and about 20,000 they have to pay tax of 30%. Plus surcharge, there is an amendment made by Finance Act 2022 in surcharge. Earlier, cooperative society was liable for surcharge of 12% if they earn more than 1 crore rupees in the financial year. But now the government has broken the surcharge in two parts. The way the surcharge is applicable to a domestic company, the same provision is now applicable to a cooperative society as well. So now for a cooperative society, the surcharge is applicable if the total income is greater than 1 crore and up to 10 crore, then 7% surcharge. And if the total income is greater than 10 crore, then 12% surcharge. So there are now two slabs of surcharge, the way it is for a domestic company. Plus cess will be applicable, health and education cess will be applicable to every SSC at the rate of 4%. Now, if a cooperative society is having a deduction under ATP, then they are not liable for AMT. This is an interlinking that I am trying to do. If a cooperative society is claiming deduction under ATP, then they are not liable for alternate minimum tax. They are exempted from alternate minimum tax. They will only be liable for the normal provisions of the income tax law and not the alternate minimum tax. Okay. Now, this small topic is about only ATP, ATP and ATP. In ATP, if a cooperative society is engaged in certain activities, they are liable for 100% deduction of their profits under Chapter 6A. Now, what are their activities? There are 4 activities in which there are further sub-activities. Activity number 1, activity number 2, activity number 3 and activity number 4. These are the 4 main activities in which there might be some sub-activities. The first activity is about certain PGBP activities. First thing, if a cooperative society is engaged in banking or providing credit facility to members, not to outsiders, then their 100% profits are deductible. But this benefit is not available to a cooperative bank. This is only available to a cooperative society, not to a cooperative bank. That too, if a cooperative society give the benefits to its members, not to the outsiders. Secondly, but if a bank is a rural development bank or primary cooperative bank or primary agricultural society, then they are eligible for the benefits under this section. Second, so by default, a cooperative society providing banking or credit facility to its members, it is eligible. Cooperative banks, it is not eligible. But these special cooperative society and special cooperative banks are eligible for deduction under this section. Next, cottage industry is eligible for deduction under this section. Next, marketing of agricultural produce which is grown by its members, not purchased by members, which is grown. Members are growing, society is marketing. Then the society will get benefit. Purchase of certain agricultural activities such as agricultural implements like purchase of seeds, livestock, other tractors, etc. And then you are supplying to members. Then also your profits are 100% deductible. Next, you are processing agricultural produce without the aid of power. They will play with these words. They will deliberately put in the question with the aid of power. Then you say it is taxable. If it is without the aid of power, then it is exempt. Okay. Which is the agricultural produce which is grown by its members. And next one, collective disposal of labor, and last but not least, fishing or allied activities. If a cooperative society is engaged in these 7 activities, their profits are 100% deductible. Apart from this, if a cooperative society is engaged in supplying milk, oil seeds, fruits, vegetable grown or raised by its members. So the members are growing all these things and society is supplying these things to these people. Who are these people? These are either federal cooperative society or local or government authority or government company, statutory company, and all of these people are supplying milk, oil seeds, etc. to what? To the general public. So ultimately the society is working for the benefits of the public at large. So the profits of the society will be subject to 100% deduction. Third one, if a society invests in another society, then 100% of interest and dividend will be deductible. So I am a society, if I am purchasing shares of another society, I'll get dividend, that is deductible. I am a society, I am giving loan to another society, that society is giving me interest, that is 100% deductible. Check. Next, if a society let out its godown or warehouse for agricultural produce and earns rental income out of it, that rental income is also 100% deductible. Check. So all these incomes are 100% deductible under ATP. Apart from this, a society will get a flat general deduction of 50,000 or 1 lakh, as the case may be. 1 lakh is for consumer cooperative society and 50,000 is for other society. So if you are in other society, you will get 50,000 flat deduction. If you are a consumer cooperative society, you will get 1 lakh rupees flat deduction. So you have to search in the question whether it is written consumer cooperative society or not. If it is written, take 1 lakh. If it is not written, take 50,000 flat deduction. Remember, all these things which you have read, which you have understood just now, all of them are deductions, are not exemptions. They are not exemption, they are deduction. First, you have to include these incomes in your gross total income, and then you have to deduct it from what? From the chapter 6. Be very careful about it. Okay. Let's move on to the second part, that is taxation of film producers or film distributors. Once I explain the taxation of film producers, the taxation of film distributor will follow it. It is exactly the copy paste situation. So I am only interested in the film producer part. Suppose there is a producer who has made a film, and he has made a film, and after that, how will he recognize his cost? Suppose the cost of production of the film is 100 crore rupees. How will he recognize the cost? So here everything depends upon the release date. If the film is released on or before 1st Jan 2023, that is on or before 1st Jan 2023 means if the film is released at least 90 days before the year ends. So if the film is released at least 90 days before the year end, that is on or before 1st Jan 2023, then the entire cost of production will be allowed as deduction in the current year. But if the film is released in the last 90 days, that is if the film is released after 1st Jan 2023, that is if the film is released from 2nd Jan to 31st March, then you have to wait and watch. Then if the producer sells all the rights of the film, then also you can reduce the entire cost of production, because the producer has sold all the rights and he has recognized the entire income, and therefore you can do what? You can recognize the entire cost also, because if the producer has sold all the rights, then you also have the right to recognize the entire cost. But if the film released in the last 90 days and you do not sell all the rights, then you have to recognize the cost as whichever is less. Whatever is your cost of production, compare with whatever money you have earned by showing the film in the movie and by selling the rights to the exhibitor. Take the total of both. Whichever is less will be allowed as deduction. So if the film is released, be very careful. You have to be very careful with the release date. If the film is released in the first 9 months approximately till 1st Jan 2023, then close your eyes and take entire cost as deduction. If the film is released in last 90 days and all the rights are sold, then also close the eyes and take the entire cost as the cost of deduction. If the film is released in last 90 days and you have not sold all the rights, you have sold some of the rights will be sold in the next year. So in that case, you compare your cost of production with the amount which you have earned so far. How will you earn the money? By exhibiting the film and by selling the rights. Whatever money you have earned, compare with the cost. Whichever is less will be allowed as deduction. Balance will be allowed in the next year. Now, there are few things which you are not going to take in the cost of production. First thing, if the movie is made by you and the government is helping you to make the movie, suppose the movie is of a social cost, so the government is helping you to make that movie. If the government is helping you to make that movie, then government is giving you fund to make that movie, so you have to reduce that from cost of acquisition. Okay, from cost of production you have to reduce that much. Further, the cost of production further will not include two things. First, the cost of making the positive prints, the prints which you are making. Every movie has to be made in some prints. Some big budget movies are made in 8,000 prints, 9,000 prints, 10,000 prints. Some small budget movies are made in 500 prints, 600 prints, 1,000 prints. So whatever is the cost of making that print, that will not be part of cost of production. Second, whatever is the advertisement cost, every movie needs some promotion and advertisement. P&A cost is there. So whatever is the advertisement cost, that will also not be allowed as deduction over here. So these two expenses will be allowed directly as deduction as a revenue expense in the year of release of the movie. So whenever the movie will release, you can claim the entire expense as a deduction in that year. You don't have to bifurcate like this over here. Okay. Last but not least, suppose the film is made, the film is completely made, and the censor board has abandoned the film. They have said that this cannot be released because of some reason. So then in that case, what will happen? If the film is not able to release, then what will happen? Will I get the deduction of the expenses? The CBDT says that yes, you will get the deduction of the expenses under section 37. Check it once. So let's go ahead with the next discussion, and that is taxation of mutual concern. The first thing which you need to understand is, what do I mean by the term mutual concern? Mutual concern means a group of people coming together to provide some services to themselves only. They are not providing services to some outsiders. So if a group of people come together to provide services to themselves only, like 10 members coming together to make a club, and then they will make a club and then provide services to themselves only, those 10 people. So that is known as a mutual concern. In that case, what is the taxability? So in that case also, you have to see what kind of mutual concern it is. There can be two types of mutual concern. One is called as trade and professional mutual concern, which is known as trade or professional association, for which there is a special section 44A. And one is other mutual concern, which is for certain time pass, etc., social clubs, etc. So now we need to see the taxability of both of them one by one. Let's talk about the other, that is social club, which is not trade and professional association. About trade and professional association, we will see after some time. Let's talk about the normal associations, which has been just made for the purpose of fun, some time pass, etc. Okay. So suppose there are a group of 10 people coming together for some purpose and everybody is contributing some money. The general receipts received from every member is exempt. Further, if any specific receipt is received from any member, that is also exempt. Why these two are exempt? The reason is very simple. Because these two are received from member. The members are the provider of money. The members are the receiver of the benefit. The provider and the receiver both are same. Therefore, it is mutually exclusive between both of them. The provider and the receiver are same and therefore tax cannot be imposed. Therefore, it is exempt. Now, the third one. If this social club provides services to outsiders, then obviously it is taxable. The question of mutual concern will go then, because now you are not providing services to ourselves, but you are providing services to outsiders. Therefore, it would be taxable now. Okay. Now let's talk about trade and professional association. The taxability over here is slightly different as compared to the left hand side. General receipts received from member, whatever is the general receipt, suppose this is 1 lakh rupees, minus general expenses, suppose this is 2 lakh rupees, and suppose this amount is surplus, then it is exempt. And if this amount is deficit, in this case, as it is a deficit of 1 lakh, then it is allowed as a deduction. So the government has shown a big heart to you all. If it is a surplus, then that they have made it exempt. But if it is a deficit, they are not saying that it is lapse. They are allowing you that against your other incomes. But how will it be set off? Listen carefully. Whatever is your other income, suppose you are receiving some money from members and some money from outsiders minus some expenses, that will be considered as your PGBP income. So whatever is the loss, you will first set off that against your PGBP income and then the balance against your other income, but maximum subject to 50% of total income. Suppose for example, this loss is 1 lakh and if your PGBP income is 50,000, okay, and if your other income is 1 lakh, so your total income is 1.5 lakhs. So you will get a maximum deduction out of this 1 lakh to the extent of 50% of 1.5 lakhs. That is, you are going to get only 75,000. 75,000 is the maximum deduction that you are going to get. Now, how are you going to set off? That 75,000 should be first set off against your PGBP. So you will knock off 50,000 and then remaining 25,000 will be knocked off against your other income of 1 lakh. This is how you are going to set off this. Apart from this, if you already have some losses of previous year to be set off, if you have some UAD of previous year to be set off, you have to set off that first and then you will take the deduction of this 1 lakh. The losses of earlier years and the UAD of earlier years have to be set off first and then this loss has to be deducted over here. Is it clear? So this is how this deduction is all about. Pay attention. The question can come on trade and professional association. Institute doesn't ask any question on this. They can ask you question on this, whereby they will give you general receipt from member, general expenses, then there is a loss, and then general receipts from members and outsiders. This will be profit and so on and so on. We have done some questions based on this in classroom also. Okay. Now, there are certain small case laws which are based on mutual consent only. There was one society who is taking some transfer charges from the members. Is it subject to tax? No, it is exempt. There is a concept of mutuality applicable over here. Society and members are one and the same thing here. It will not be subject to tax. Similarly, there was one society who was taking incoming and outgoing charges from every members who are selling the house or who are buying the house in the society. Again, it is not subject to tax because it is for what? It is considered as a mutuality, mutual income. It is considered that the society and the members are one and the same person. The profit is not the motive over here. Motive over here is to come together and provide services to each other. Therefore, it will not be subject to tax anymore. Again, there is a club in which the people are depositing some funds and the club is earning some money over here. So there is a Madras Gymkhana Club versus DCIT Madras. Interest earned on surplus funds of a club deposit with institutional members. So institutional members means outsiders. You are depositing your money with some outsiders. Suppose the club has some sub funds. Suppose our residential society has 1 crore rupees surplus. So we are investing that in ICICI Bank. Now, if we are earning some interest from ICICI Bank, obviously it is outsider. It is not mutually exclusive. It is not our member. It is not a part of our society. It is outsider. Therefore, it does not satisfy the concept of mutuality and therefore it is taxable. Check it please. So you have to see whether you fulfill the concept of mutuality or not. If you fulfill the concept of mutuality, it is exempt. If you do not fulfill the concept of mutuality means what? The buyer and the seller has to be same. Mutuality means what? The provider of the service and the receiver of the service has to be same. At that point, we can say that we are mutually same. Okay. So now let's go ahead with a big one and an important one, that is taxation of firm, which will also include LLP. Whenever we are going to talk about firm in this chapter, that will automatically be applicable to LLP also. So first of all, what is a firm? A firm is a partnership firm which is registered under Partnership Act 1932. Okay. But under income tax law, you also have to fulfill certain other conditions, like there has to be a deed, like individual share of every partner has to be mentioned in the deed, like when you file the return for the first time, you have to accompany this deed with the return of income. So you have to send this deed along with the return of income. Like your deed should be certified by all the partners, not being minor. If a minor partner is not certifying, that's all fine. Next, if there is a change in your deed, means if there is a change in your partnership firm, like there is some admission of partner or retirement of partner, then you have to file a revised instrument. If you do not do all these things, the law says that then the partnership firm will not get the deduction of remuneration and interest paid to the partners. Generally, what happens when a partnership firm pays remuneration and interest to the partners, the partnership firm gets deduction of that. But if you do not fulfill these conditions, which is mentioned over here, these are some technical requirements which you have to fulfill being a partnership firm. But if you do not fulfill them, then you are not going to get the deduction of remuneration and interest. Sir, what about partners? The firm will not get the deduction. What will happen in the hands of the partners? In the hands of the partners, that remuneration and interest will become exempt. The government cannot dually tax, double tax. Here also we will disallow, there also will tax. No, no, no. The government will disallow here and will exempt in the hands of the partners. Okay. Next. Now there are certain small sections not very important. Let's go through all of them one by one. First is change in constitution of the firm. What do I mean by change in constitution of firm? The change in constitution of firm is mentioned in section 187, which says that there is a minor change in the firm. Say A, B, C are three partners. Now one partner is going, C is going, and in place of C, D is admitted. This is a change in constitution. Okay. So in that case, will the firm file two returns? No. Firm will file only one return. Only one return will be filed. Now, in case in future, if there is a tax liability coming for this year, then who will be liable? All the partners will be liable. A will be liable, B will be liable, C will be liable, D will be liable as per 188A. Because 188A says that every person who is a partner in a financial year is liable for the liabilities of the firm along with the firm. So therefore, if C is leaving the firm in the current year and D is joining, then C is also liable and D is also liable. Unfortunately, both of them will be liable along with A and B, because A and B are anyways there from the very beginning. Next, what do I mean by succession of firm? Succession of firm means what? All the partners are changing and all new partners are suddenly coming. Suppose there are three partners in a firm, A, B, C, and A, B, C, all of them retired, and suddenly D, E, F came in place of A, B, C. In this case, it is not a change in constitution of a firm. This is not a minor change in the firm, but this is a big change in the firm. This is a revolution in the firm, and this is called as a succession. And in case of succession, the firm has to file two returns. One return will be filed by the predecessor, one return will be filed by the successor firm, one return will be filed by ABC, one return will be filed by DEF. Next, liability, as I have said you, every partner has to bear the liability in the year in which they are partner. Next, what happens in case of dissolution of a firm? In case of a dissolution of a firm, what happens? At the time of dissolution, whomsoever is the partner, that person will be liable for the liability of the firm for life. Be very careful. Suppose if today dissolution happens and if I am a partner of a firm, whatever is the liability of the firm for the entire life of the firm, I will be liable for that along with the firm. So, at the time of dissolution, you should not be a partner. If you are a partner at the time of dissolution, you have to bear all the consequences that a person has to bear in respect of a firm. Be very careful. Let's go ahead with the tax rate. Now, what is the tax rate? The tax rate for a firm is flat 30%. We all know that. Surcharge is applicable if the total income exceeds 1 crore, and cess will be applicable at the rate of 4% always. Okay. Now coming to the most important part, that is remuneration and interest to partners. Okay. So now when remuneration and interest will be allowed to the partnership firm and LLP, there are some conditions that we have to fulfill. First, remuneration is allowed only if you pay to working partners, but interest is allowed if you pay to any partner. Interest can be paid to working partner also, sleeping partner also. Second, remuneration is allowed only if you pay to individuals. Interest can be paid to individuals, firm, company, any person you can pay interest, you will get the deduction. Third one is similarity. Remuneration and interest both should be authorized by the deed. What should be written in the deed? For interest, rate of interest should be mentioned in the deed, and that rate of interest should not exceed 12% per annum. If it is exceeding 12% per annum, then the government will restrict that to 12% per annum. Above 12%, it will be disallowed. What should be written for authorized deed? What should be authorized in the deed for remuneration? Either the amount of remuneration should be mentioned, or the manner in which remuneration will be paid should be mentioned. Either you should mention that remuneration will be 50,000 rupees per month, 60,000 rupees per month amount, or you should mention in the deed that remuneration will be paid at the rate of 90% of the profit, 70% of the profit, 50%. It has to be, the manner has to be mentioned. Either of the two. Even the CBDT circular is saying the same thing which is mentioned over here, and even the Himachal Pradesh High Court is saying the same thing which is mentioned over here in point number 4. You can check. Point number 5 is the last point over here, which says that remuneration and interest both has to be prospective, not retrospective. For example, suppose we are putting the clause of remuneration in the month of October, that we will pay remuneration to the partners. So if you are putting the clause of remuneration in the month of October, then the deduction will be allowed from October, not from April. You cannot put a clause in the month of October that partners are eligible for remuneration from April. No, retrospective clause is not allowed. It has to be prospective, prospective, and prospective. Is it clear to all of you? I hope it is clear. Then this is a circular which is saying the same thing which I mentioned above, and this ATIA point we will be discussing in the later points. Okay. Next point, coming to the next point. Suppose if I am paying some interest to the partners on current account. Okay. Sorry. Suppose if I am paying some, I am a firm, you are a partner. I am paying some interest to the partners on capital account. It is mentioned in the deed that the partners are paying interest on capital account. Then interest on capital account will be allowed. Now at the same time, if I pay interest on current account also, will I get the deduction? No. The deed has to mention about both. Unless and until the deed is mentioning about current account also, you are not going to get the deduction of interest on current account, unless and until it is mentioned in the deed that the partners are eligible to get the interest on current account also. So just mentioning that interest on capital account, you cannot take the deduction on interest on current account. Moral of the story is very simple. If you have written in the deed about capital and current both, then both will be allowed, or else both deduction will not be allowed to you. Okay. Now, interest, how much it is allowed? As I have told you, maximum 12%, not more than 12%. Remuneration, how much it is allowed? It depends upon the book profit. If your book profit is negative, then 1,50,000 flat. If your book profit is up to 3 lakh, then it is 1,50,000 or 90% of book profit, whichever is more. And if it is above 3 lakh, then it is 60% of book profit. Okay. So for example, if your book profit is 5 lakh, so up to 3 lakh, it will be 90% of book profit, that is 2,70,000. And then above 3 lakh, that is on remaining 2 lakhs, it will be 60% of book profit, that is 1,20,000. Now, is this the standard deduction I am going to get? No, 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 no. This is the maximum deduction that you can get. This will be compared with your actual remuneration paid to the partners, and whatever is lower will be allowed as deduction. This is not the standard deduction that you are going to get. This will be compared with your actual remuneration that you are going to pay to the partners, and if the actual is lower, then lower. If the actual is more, then this much will be allowed to you as a deduction. Okay. Now, what is book profit? Book profit is nothing but a PGBP income only. It is just that you have to take a net profit as per PNL, do all the PGBP effects, and then you have to add back the remuneration if it is debited to PNL, because that is the amount we are going to find out. The amount which is debited in the PNL in the form of remuneration is your actual remuneration. That is not allowed as deduction. That actual needs to be compared with the maximum amount, and whichever is lower will be allowed as deduction. So book profit is nothing but your PGBP income. PGBP income plus add back what? Add back profit. Add back remuneration. That's it. Now, while solving a question, what you will do? First, you will find out book profit. While finding the book profit, ignore brought forward loss, because brought forward loss does not come in PGBP. It comes in set off and carry forward section 70 to 80. Ignore chapter 6A, because chapter 6A again does not come in PGBP. It comes in section 80C to 80U. So while solving the sum, first find out book profit. While finding book profit, ignore these two things. Then find out remuneration. Once you got the remuneration, you find out the total income, and while computing the total income, you have to consider the brought forward loss also. You have to consider the chapter 6A also, and then you can compute what? Your tax liability. Okay. Now, there are some explanations over here which speaks about certain clarifications regarding interest. Suppose I am a partnership firm and you are a partner, and you are an HUF, and HUF is a partner. So suppose if an HUF is partner and the Karta is representing the HUF, and if the Karta gives me the money, is the Karta partner? Karta is not the partner. Partner is HUF. And if the Karta gives me money out of his personal pocket, out of his personal capacity, so if the Karta gives me the money, and if I gives interest to Karta, that cannot be covered in 40B, because Karta is not a partner in the firm, but Karta is just a partner in a representative capacity on behalf of the HUF. And therefore, if the Karta gives me money out of his personal capacity and I pay interest to Karta, that shall not be considered under 40B, because that interest is not paid to what? A partner, because the partner is not Karta, partner is HUF. These are some of the exceptions which are mentioned over here, and vice versa case is mentioned over here. You can go through this. Next one is the Allahabad High Court case law, which says that suppose there is a partnership firm and there is a partner. Now, if you know section 40A2 in PGBP, it says that partnership firm and partners are related parties. So if you make any payment to your related party in excess of fair market value, then it is disallowed. So for example, I made a payment of 40 lakh rupees as remuneration to my partner. Now that 40 lakh rupees is much higher than the fair market value. Suppose the fair market value is just 5 lakh rupees. But this 40 lakh rupees is as per the limits of 40B. This 40 lakh rupees is paid to a working partner. This 40 lakh rupees is paid as per the law. This 40 lakh rupees is mentioned in the deed. Then whether 40A2 will come into picture and disallow the excess amount because it is greater than fair market value, or 40B will prevail on it. So the Allahabad High Court has held that if the assessee fulfills the conditions mentioned in 40B for paying remuneration, then the remuneration shall be allowed if it is within the limits of 40B. You should not see 40A2. It means the provisions of 40B will override over here to the provisions of 40A2. You cannot get into the transaction value and the market value of each and every remuneration which is paid to the partner. You have to give the deduction based on the limit set by section 40B. Okay, that is what it is mentioned over here. Next. We all know that the whatever share of profit the firm gives to the partner, it is exempt in the hands of the partner, right? Under section 10(2)(a). Now, what if the firm does not pay tax on that profit? Suppose the firm is earning a profit of 100 lakh rupees, and on that 100 lakh rupees, the firm is not paying tax because the firm is getting exempted under some provisions of the income tax law. Will it be still exempt in the hands of the partners? The answer is yes. The CBDT circular says that the share of profit from a firm in the hands of the partner will always remain exempt, irrespective of whether the firm has paid tax or whether the firm has not paid the tax. The firm has paid the tax, then also it is exempt. If the firm has not paid the tax, then also it is exempt in the hands of the partner. Be very careful. Okay. Next. Will a assessee opting for 44AD, ADA, ADAE will get the benefit of remuneration and interest deduction? The answer is no for 44AD and ADA, and yes for 44AE, which I have told you earlier also. I have interlinked here also. In case of presumptive income under 44AD and ADA, you do not get the deduction of remuneration and interest paid to partners. But in case of the truck wala section 44AE, you get the benefit of remuneration and interest deduction over here. You can check it over here. Next, what happens in case of loss? If there is a loss in the last year, suppose there were 4 partners in last year's. Okay, last year 4 partners were there, A, B, C, D, and there was a loss incurred by 4 partners to the extent of 8 lakh rupees. What will happen with that loss? If one of the partner in the current year retire or is dead. If one of the partner in the current year retire or dead, then the proportionate loss government says will be disallowed. Only loss, not UAD, only loss. How much loss? First of all, find out the share of the retired or deceased partner in the brought forward loss. So out of this 8 lakh, how much is the share of that loss in the current year? So equal profit. So 2 lakh rupees is the share of the retired or deceased partner in the brought forward loss. Then compare, what is the current year's profit? Current year's profit is 3 lakh rupees. Okay. Now suppose current year's profit is 3 lakh. What is the share in the current year's profit? Current year's profit share is, say for example, 1 lakh rupees. Okay. Then the differential amount of 1 lakh rupees will not be allowed to be carried forward. So you have to see that what is the share of that retired partner in the loss. Then you have to see what is the share of that retired partner in the current year profit. The differential amount, whatever it comes, will not be allowed to carry forward. The balance can be carried forward by the firm and it will be allowed as deduction. Okay. So this is what this small chapter is all about. Very important, very important for your exam partnership firm. Okay. 40B, especially the calculations of 40B are very important. One last thing over here. Sir, will this section be applicable if the partner does not die and does not retire and if there is only a change of PSR? No. This section is only applicable if the partner retires or dies. This section is not applicable if the partnership firm just change the PSR between the 4 partners and there is no retirement and there is no death. Okay, then this section is not applicable. Next. Suppose if an HUF pays some remuneration to Karta or any member, will it be allowed as deduction? Yes, the Supreme Court in the case of Jugal Kishore Baldev Sahai has held that the partnership, the HUF making payment of remuneration to partner, 2 members will be allowed provided some conditions are fulfilled. First of all, there is a bona fide agreement between HUF and the member. Then the member should work for the business of the family. Third, and the remuneration paid to the member should be reasonable and it should not be excessive. Otherwise, it will be disallowed under 40A2 because HUF and members are considered to be relative under section 40A2. Okay. So this is a small case law which talks about the remuneration deduction to the HUF when it is paid to the members or Karta. Next, taxation of political parties. So for political party, there are a lot of exemptions which are given under section 13A. First one, HP is exempt, CG is exempt, IFO is exempt, voluntary contribution is also exempt subject to some conditions. Only PGBP is taxable for a political party. HP is exempt, CG is exempt, IFO is exempt, only PGBP taxable. Voluntary contribution also exempt subject to some condition. First, if they get some contribution, some donation, that is also exempt. They have to keep and maintain some documents. Okay. If the voluntary contribution is greater than 20,000 rupees, then they need to keep the record of the name and the address of the donor. They need to keep the records of the name and the address of the donor. And the books of accounts have to be audited by a chartered accountant. They have to fulfill these conditions. Then the donation received is also exempt. Okay. Further, they have to fulfill some conditions. What is that condition? The first condition is they have to file the return on time. If they don't file the return on time, they are not going to get the exemption. They are going to lose the exemption. They have to file the return on or before the due date under the income tax law. If they don't do, then they will lose the exemption. Second thing, if they receive a donation of more than 2,000 rupees, there is a mistake over here in some of the books. It might be more than equal to, but it's wrong. It's more than 2,000. If they receive a donation of more than 2,000 rupees, then in that case, they have to receive by 4 modes: account pay check, account pay draft, ECS, such as electronic mode, or electoral bonds. They have to receive by electoral bonds. So electoral bonds or 4 modes. If they are receiving donation of more than 2,000 rupees, they have to receive it by electoral bonds or 4 modes. They have to receive by these 5 modes or else the donation will be taxable. Okay, what are electoral bonds? I have told you in the class that has been done deliberately to evade tax. that has been done deliberately by the political parties to hide the identity of the donor who is giving them donation. Okay. Next, taxation of electoral trust. What is an electoral trust, sir? Electoral trust is what? Electoral trust is nothing but a mediator. There is a political party over here. There is a donor over here. There are big corporates over here in the form of donor. There is political party over here, and there is a mediator in the form of electoral trust. So the corporates will give donation to the electoral trust, and electoral trust will give the money to the political party. So electoral trust works like a mediator. So whatever donation electoral trust gets will be exempt if 95% of the donation is distributed to the political parties. So if the electoral party receives 100 crore, they have to distribute 95 crore to the political parties. So what if they don't distribute 95 crores, but they distribute only 94%? Then the entire 100 crore will be taxable in the hands of electoral trust. It is very simple provision. So once you receive 100 rupees, you have to distribute 95, not even 0.1 percentage less than 95. If you distribute 0.1 percentage less than 95, entire 100 crore will be taxable in your hands. So receive 100, give 95. Suppose I receive 100 and I gave 96, all fine. Now next year I again receive 100. Then in next year you have to give 100 plus last year surplus 4 rupees, 104 ka 95%. So next year you have to give 95% of the current year donation plus last year surplus, whatever is left, you have to give 95% of that. What about other income earned by the electoral trust? If the electoral trust is earning some other income, that will be taxable like a normal person. For example, if the electoral trust is keeping its money in bank account and they are receiving some interest from the bank, then that will be taxable like a normal person, the way it is taxed to other assessees. Okay. What is the advantage to the donor? The donor will get deduction under 80 GGB and 80 GGC. 80 GGB and 80 GGC, both the sections are eligible for the donor. 80 GGB for Indian company, 80 GGC for other companies. Okay, that we will learn in the later topics in the chapter 6. Okay. Now let's go ahead with the next one, and that is taxation of AOP and BOI. Again, this is an important topic. There are two topics which are important in this chapter. One is taxation of firm. Another is taxation of AOP BOI, association of person, body of individuals. Now there can be two types of AOP BOI. First type is where the shares of the members are determinate and known, and second is the shares of the members are unknown and indeterminate. That is, we don't know what is the share of which member. Okay, so now let's see the first one, where the shares of the members are known and determinate. In this there are three cases. Let's talk about case 1, then case 2, and then case 3. We are supposed to talk about two things over here. What is the taxability in the hands of AOP BOI, and then what is the taxability in the hands of the members also. Okay, so now when you will come in case 1, you will come in case 1 when none of the members have total income greater than basic exemption limit. It means that suppose there are 3 members, all members total income has to be less than the basic exemption limit, which is 2.5 lakhs, 3 lakhs or 5 lakhs as the case may be, and none of the members are foreign company. They have not written foreign company, but indirectly it means foreign company only. They have written none of the members are assessable at a rate higher than MMR. What is MMR? MMR is 42.744% is MMR, as you can see over here on the next page. The MMR is 42.744%. So they are telling us that none of the members should be chargeable at a rate higher than MMR, and there is only one person in this country who is chargeable at a rate higher than MMR, and that is a foreign company. So if you want to come in case 1, then there you are supposed to fulfill two conditions. First, none of the members, all the members income should be less than basic exemption limit. Which income? The other income other than from AOP BOI. The total income other than from AOP BOI should be, don't count in the in this total income, don't count the AOP BOI income. This only talks about their other income. All members other income has to be less than basic exemption, and all the members should be not foreign company. Not even a single member should be a foreign company. If you fulfill these two conditions, then AOP BOI will be taxable at individual rates, 2,50,000, 5 lakhs, 10 lakh, etc. That is the rate at which AOP BOI will be taxable. Now, how the members will be taxable? The members will be taxable by making a separate statement under section 67A. How? The members' income will be segregated into two parts. Part 1, whatever they get from AOP BOI, that is, they get what? They get remuneration, they get interest, they get share of profit. All these three will be part 1. And then other income will be part 2. Then the total income of the member will come. Then you are supposed to take the basic tax. Don't take surcharge and cess as of now. Just take the basic tax. Then you will get relief over here. Which relief? Whatever is the basic tax multiplied by whatever is the part 1, that is income from what? AOP BOI, that is share of profit, remuneration, interest, will be in the numerator, divided by the total income. will be getting as a relief under section 86. Okay, so you'll be getting the relief under 86 like this. How? First of all, compute tax multiply by share of income from the AOP in the numerator divided by total income from AOP divided by total income of the member will be considered as a relief. Then you can consider that if your income is less than 5 lakh rupees, you can also take the relief under 87 if you are eligible for that. Okay, and this is how you are going to compute the tax in the first case. When will I come in the second case? You will come in the second case if one or more members have income greater than basic exemption limit. Suppose if even one member is having income greater than 2,50,000, and even now in the second case also no foreign company will be introduced in third case. Then in that case the rule is very simple. The entire income of AOP BY will be taxed at 42.744 and members income will be exempt. That's it. Members will not be liable for MAT also if the member is a company. They are not liable for MAT. Okay. Third case, when one of the more members are foreign company, then what has to be done? Then the AOP's tax will be computed in two parts. Suppose there are three members, one third, out of that one member is a foreign company. Then two tax calculations will be done. For foreign company share, 43.68, that is foreign company's tax rate. And for other member shares, it is MMR, 42.744. Check. You have to make two computations. And then in the hands of member, again in the hands of member, the share of income which is coming from AOP BOI is exempt under section 86. Now, what if the share is unknown and indeterminate? If the share is unknown and indeterminate, there are only two cases now. First case, where all the members are not foreign company, none of the members are foreign company, all of the members are Indians. Then in that case, the entire income of the AOP will be taxed at MMR, and in the hands of member, it is exempt. But even if one member is foreign company now, if one member is also foreign company now, then in that case, the entire income of the AOP BOI will be taxed at 43.68. Members' income will be exempt under 86. MAT will also not be imposed on member. Okay. What is the definition of MMR? It is given over here. What is 40B saying? 40BA? 40BA is saying that in case of AOP BOI is not going to get any deduction of interest and remuneration the way a partnership firm gets deduction under 40B. In case of AOP BOI, the deduction of remuneration and interest is disallowed for AOP BOI when it is paid to members. Okay, be very careful. No MAT will be imposed. That is something which I have told you. Okay, now coming to the next topic, which is a big one now. That's a long discussion now, which will go on and on for hours and hours. Let's talk about the assessment procedures for filing of returns, appeals, rectification, revisions, income escaping assessment, so on and so forth. Now, there are a lot of things to speak over here. We'll speak about all of them one by one. Now, for us, first of all, for May 23 and November 23 exams, the financial year is 22-23. You have to be very careful about that thing first of all. Okay, the financial year is 22-23. This is the first thing that you have to keep it in your mind. Now, this is the procedure of assessment that first you will file the return, then the department will send you scrutiny notice, then the proceedings will begin, and then the department will pass the order. If you are not satisfied with the order, you can go for appeal, rectification, revision. This is the procedure of your assessment. I am not interested in the procedure as of now. I am interested in section by section as of now. The first thing which we are going to discuss and revise today is section 139 subsection 1. That is, who is obligated to file return first of all, and secondly, when the return will be filed, what is the due date of filing of return. First of all, who is obligated? First, a company and a firm is always obligated to file return. It means a company and a firm is always liable to file return irrespective of their total income, irrespective of their positive income or negative income. They are liable to file return. Others. When are others liable to file return? When their gross total income is greater than basic exemption limit. If their gross total income is greater than basic exemption limit, then they are liable to file return. Gross total income means what over here? Over here, gross total income means income before giving the effect of chapter 6A and income before giving the effect of exemptions under 54. So you have to consider that income which is before chapter 6A and that income which is before exemptions under 54 series, 54, 54B, 54D, all the 54 series. So you have to add back those two deductions and exemptions and then check whether the exemption, whether the limit is crossing 2.5 lakhs, 3 lakhs or 5 lakhs or not, and then decide whether they are liable to file the return or not. This is an important point. So this is the first category of assessees who are liable to file the return. Let's talk about the second category of assessees who are liable to file the return. If you are an RNOR and if you have any asset outside India, or if you are having a signing authority in any account located outside India. So if you are an RNOR individual, if you have an asset outside India, signing authority in any bank account outside India, or any financial interest in any entity or any firm or any company outside India, then also you are supposed to file the return irrespective of whether your gross total income exceeds basic exemption limit or not. It doesn't matter. It comes in a different proviso. This is a separate provision. You have to file the return. This is the second category. The third category, let me talk about the categories, all of them first of all. The third category. The third category is if you deposit more than 1 crore rupees in one or more current account in a bank or cooperative bank. If you deposit more than 1 crore rupees in a financial year in one or more current account in a bank or a cooperative bank, you are liable to file return. Or if you incur an expenditure for a foreign tour, travel to a foreign tour of 2 lakh rupees or more for yourself or for any other person, you are incurring, your parents are going, then also you are supposed to file the return. So if you incur more than 2 lakh rupees for foreign tour for yourself or for any other person, foreign tour, not in India, for yourself or any other person in excess of 2 lakh rupees, you are supposed to file the return. Check. Next, if you incur an electricity expense of more than 1 lakh rupees in the entire financial year, you are supposed to file the return. Check. Now, there is one more category who is not liable, who is liable to file the return, that I'll be dealing later on in the latest circular, because that has been introduced in the latest circular by CBDT, that I'll be discussing later on. Okay, that I'm not discussing as of now. Now, there is one person to whom the government has given exemption from filing ROI. That is, who is that person? Suppose if there is a non-resident or a foreign company, imagine there is a non-resident foreign company outside India. He is investing in an investment fund. He is investing in an investment fund which is located in IFSC. So if a non-resident who is outside India, he is investing in an investment fund which is located in IFSC, and he's earning some income from that investment fund, and his TDS is also deducted, and he's not earning any other income. He's not earning any other income. So if a non-resident foreign company is investing in an investment fund which is an IFSC, he's earning some income from this investment fund, he's not earning any other income, his TDS is also deducted by investment fund. While making the payment, investment fund has deducted the TDS, he is not liable to file the ROI. No need to file the income tax return. But if the department sends him a notice under 142(1) or 148, then he has to file the return. He does not have to file the return on his own under 139(1). He is exempted from 139(1). But if the department wants to check him and department sends him a notice under 142(1) or under 148, then in that case, he is supposed to file the return. He has to file the return. So these are the few cases where the assessee is liable to file the return. First is this case, second is this case, third is this case. In the third case, there are 3 points, and fourth is which is exempted from filing ROI, and there is one more case who is liable to file ROI, that will be dealing later on in the latest circular. Now let's talk about the due dates of filing of return. There are 3 due dates of filing of return. One is October, one is July, one is November. First of all, let's talk about November. November is applicable to assessees covered under transfer pricing. So all those assessees who are liable for transfer pricing, who are engaged in domestic transaction or specified domestic transaction or international transaction, they are liable for transfer pricing. For them, the due date is 30th November. What about 31st October? Company will always file on 31st October. Always, always and always company will be filing the return on 31st October only. Other than company, also 31st October if they are liable for audit. If a firm is liable for audit under income tax law or any other law, if a LLP is liable for audit under income tax law or any other law, it doesn't matter, only income tax, liable for audit under any law, including income tax law. If any person is liable for audit, they will be liable to file the return on 31st October. Third one. If a partnership firm is liable for audit, then the partners will also be filing the return on 31st October. Similarly, if a partnership firm is liable for transfer pricing, then the partners will also file the return on 30th November. So if the partnership firm is liable for audit, then the partnership firm will file on 31st October. So partner will also file on 31st October. Sleeping partner, working partner, both the partner. If a partnership firm is liable for what? Transfer pricing, then the firm will file the return in November. So the partners will also file the return in November. One more thing is there over here. And the next point is with respect to certain states. Certain people residing in Goa, Diu and Daman, Dadra and Nagar Haveli. For them, there is a Portuguese law which is applicable, which says that whatever income is earned by husband will be divided equally with wife, and whatever income is earned by wife will be divided equally with husband, except salary income. Salary income will not be divided between both of them. Suppose if a husband is earning 1 crore PGBP income, then 50 lakhs husband, 50 lakhs wife. Suppose if a wife is earning a house property of 50 lakh rupees, then 25 lakhs wife, 25 lakhs husband. So in that case, what happens? Suppose if a person who is residing in Goa, Diu and Daman or Dadra and Nagar Haveli, for which section 5A is applicable of Income Tax Act, and for them Portuguese law is applicable even today. So what happens in that case? Be very careful. Suppose if a husband is a partner in a partnership firm, and if the partnership firm is a filing return on November or in October, then the husband will be getting remuneration from the firm. So suppose husband is getting 20 lakh rupees remuneration from a firm. So 10 lakhs is of husband, 10 lakh is of wife. So in that case, even wife has to file the return in November and in October. That's what it is written over here. So if the husband is subject to what? If husband is residing in what? In the state of Goa or in the Union Territory of Dadra and Nagar Haveli, Diu and Daman, then in that case, Portuguese law says that 50% income except salary income. So even remuneration and interest on the partnership firm will be subject to 50-50, husband 50, wife 50. So it has to be divided between the spouses equally. So in that case, what will happen? If the firm is filing the return in November and if the husband is a partner, then the wife is also liable to file the return in the month of November. Or if the firm is filing in October, then the wife is also liable to file the return in October. You can check it over here. Okay. Next. What are the consequences of not filing the return on time? There are a lot of consequences. First of all, certain PGBP losses and capital gain losses will not be allowed. You will be liable for interest under 234A, fee under 234F, best judgment assessment can be done against you. You will be liable for what 142(1) notice can be sent by the assessing officer or prescribed authority to you. Then exemptions under section 11 for trust and 13A political party will be denied to you. Then ATSC says that no profit link deductions will be allowed to you. Now let me talk about some of them as of now. First of all, if you are not filing the return on time, no profit link deductions will be allowed to you. There are in all 15 profit link deductions under the income tax law, and none of the profit link deductions will be allowed to you if you do not file the return on time. Second, if you do not file the return on time, there can be a fee which can be imposed on you, which can be 5,000 rupees. And if your total income is up to 5 lakhs, then it is only 1,000 rupees. Okay. So for normal assessee, it is 5,000 rupees if you do not file the return on time. But if your total income is up to 5 lakh rupees, then it is 1,000 rupees for you. Okay. Now there are certain special assessees. Special in the sense they are liable to audit, and therefore all of them will file the return on 31st October. Okay. So what is the provision over here for all of them? Pay attention, please, all of you. There is a charitable trust or a religious trust. Suppose there is a charitable trust or a religious trust. Okay. When they will file the return? They will file the return because they get a lot of exemptions. So if their income before exemption is greater than basic exemption limit, they are liable to file the return. So if their income before giving the exemption is greater than basic exemption limit, they are liable to file the return. Suppose their income is 10 lakh and after exemption it becomes 0. So before exemption it is how much? 10 lakhs. So they are liable to file the return. Along with that, they are also liable for fee under 234F if they don't file the return, and with that they are also liable for a penalty under 272A. Please change this. This has become now 500 from Finance Act 2022. I'm sorry for that. This has become 500, which is mentioned in the later chapter, but still you change here also. So they will be liable for a penalty also of rupees 500 per day for late filing of return, along with rupees 5,000 rupees fee or 1,000 rupees fee. Similarly, political party, when are they liable to file the return? If their total income before giving exemption is greater than basic exemption limit. As you all know, just now we have seen that political parties are eligible for a lot of exemptions under 13A. So if their total income before giving the exemptions is greater than basic exemption limit, they are also liable to file the return. Right? And if they don't file the return, then they are liable for only fee under 234A, no 272A penalty. Similarly, certain institutions whose income is exempt under section 10, again they have to check if their total income before giving the exemptions under section 10 is greater than basic exemption limit. If yes, they are supposed to file the return in October. All of them are supposed to file the return in October. They are liable to pay fee of 234F, 5,000 or 1,000 or 500 rupees per day. Penalty also they are liable to pay. Then certain universities which are covered as scientific research, social science, statistical research, associations, etc. No limit, they are always supposed to file the return and they will be liable for fee. Then business trust, investment fund, two separate topics we are going to deal later on. No limit, always file the return. 31st October, they are liable to pay fee of 5,000 or 1,000 rupees. No penalty over here. Penalty is only in first section and in the third section over here, not in the rest of the four. Okay. Next. 139.3 will talk about loss return. If you want to carry forward a business loss or a capital gain loss, you want to carry forward and set off in next year, then file the return on time. File the return on time. If you want to carry forward and set off in next year, then file in the return on time. Sir, what if I want to set off in the current year? If I want to set off my current year loss in the current year, then there is no need to file the return on time. The problem is on when you want to carry forward the loss to the next year, then you have to carry forward the loss only if you have filed the return on time. So if you have a loss in the current year, and if you want to set up that loss against the income of current year only, then there is no need to file the return on time. Similarly, this restriction is only applicable for PGBP and CG loss. This restriction is not applicable for house property loss. This restriction is not applicable for unabsorbed depreciation. For unabsorbed depreciation, the government says that you can carry forward even by not filing the return. Even if you don't file the return, you can carry forward the unabsorbed depreciation. There is no harm in that. Check it, please. This restriction is further not applicable on brought forward losses. Suppose if in the last year you have filed the return on time, so you can carry forward that loss, and in the current year you have not filed the return on time, you can carry forward that loss to the next year. In the current year, if you do not file the return on time, it does not mean that the last year's losses will also get lapsed. Don't worry about it. Okay. Now, because of some genuine reason, I am not able to file the return on time. Will I be allowed to file the return late and allowed to carry forward the losses? The government has brought a CBDT circular which is very important for us over here, which talks about if there is a genuine reason. And if there is a loss in your case, or if there is a claim of refund in your case, if there is a loss in your case which you want to carry forward, or if there is a refund which you want to take it from the government, you can make an application to CIT if your claim is up to 10 lakh rupees. So if your claim is up to 10 lakh rupees, you can make an application to CIT. But if your claim is more than 10 lakh, up to 50 lakhs, then you have to make an application to Chief CIT. And if your claim is more than 50 lakhs, then you have to make an application to CBDT. then CBDT will look into the matter and will allow your application. They will not allow your application beyond 6 years from the end of the relevant assessment year. So for financial year 22-23, assessment year 23-24, they will look into the application only if you make application by 31st March 2030. That is 6 years from the end of relevant AY. If you go beyond that, then they will not entertain the application. Okay. Sir, if they give, will they give me refund? Yes, they will give you refund. Sir, will they give me interest on refund? Please don't ask for that. Interest on refund will not be allowed. Only refund amount will be received to you. They will not pay you any interest on that refund. Please be very careful. Next, belated return. If you are not able to file the return on time under 139(1), then you can file a belated return. By which date? By 31st of December of the relevant AY, or before completion of assessment, whichever is earlier. Sir, which assessment is completed even before filing the return? It is the best judgment assessment which is completed even before filing the return. So for financial year 22-23, you can file the return by 31st of December 2023. But if the assessment is completed on 15th of December by the assessing officer, sir, completion of assessment means the AO has passed the order by 15th of December. Then you should have filed the return before 15th of December, that is by 14th of December. But if the assessment is not completed, then you can file till 31st of December, that is allowed to you, okay? You can check it. Now, there is one more concept brought by Finance Act 2022, that is updated return. That is a different concept. For that, we'll talk later on in different chapter, okay? Don't worry about it. This is a different concept. So, before completion of assessment, whichever is earlier, before completion of assessment, so 31st December or before completion of assessment, whichever is earlier. Which assessment? 144 best judgment. What do I mean by the term completion of assessment? It means date of passing of order and not date on which you receive the order. So, date on which the department has signed the order, that date is considered as the date of completion of order, and not the date on which you receive the order at your home. That date is not considered as the date of assessment. Next, revised return means what? Once you have filed the return, original return or belated return, whichever return you have filed, if you have made some omission or wrong statement, you can revise. What is the time limit? Time limit is same as above. By 31st of December or before completion of assessment, whichever is earlier. Sir, how many times I can revise a return? You can revise a return for n number of times. There is no restriction. Sir, can I revise a loss return also? Yes, you can revise a loss return also. Can I revise a return after receiving the scrutiny notice also? Yes, why not? You can revise a return by 31st December or before completion of assessment. Assessment is not completed when notice is given. Assessment is completed when order is passed. So, before order is passed, you can revise anytime. There is no issue in that. Sir, can I revise the return for n number of times? Yes, you can revise the return for n number of times. That's what it is given over here. Okay. Last but not least in this small topic, that is defective return. Sir, what is a defective return? Defective return is a return in which the AO finds out some defects and he will intimate you. And if he will intimate you, he will give you an opportunity of being heard. He will give you 15 days or he may also give you extension if you ask for. Then within that extended time, you have to what? You have to file a new return. You have to rectify the defect. If you don't rectify the defect, then in that case, it is called as you have to reply within 15 days. Then if you do not reply within the time allowed to you, then the return will be called as void ab initio and they will take all the actions that is necessary against you as if you have not filed the return. Check it please. So let's go ahead with the next chapter and that is your assessment procedure. Let's talk about one by one all the sections over here. The first section is 142 subsection 1 clause 1 which talks about filing of return. That is, if the assessee does not file the return on time, then the AO or the prescribed income tax authority may issue you a notice to file the return. So, if you do not file the return on time, then the AO or a prescribed income tax authority which is not below the rank of ITO shall also issue you a notice under 142(1) and then accordingly you have to file the return. Within how many days I am supposed to file the return? You are supposed to file the return within the time limit mentioned in such notice. Suppose if the notice say that you have to file the return in 15 days, then you have to file the return on 15 days. Now, next, is it mandatory to issue this notice to do best judgment assessment? No. To do best judgment assessment, it is not mandatory to issue this notice. For best judgment assessment, there are some other criteria which we are going to see later in this lecture itself. Next, can I file this return late? No. If the time allowed in the notice is 15 days, you have to file on time. This return cannot be filed belatedly. Once I file this return, can I revise this return? No, once you file this return cannot be revised also under 139(5). It is not possible to file this return belatedly. It is not possible to revise this return also. Okay. Next, apart from this section also gives the power to the assessing officer to do some preliminary inquiries. Like he can call for your accounts, he can call for your documents, he can call for your other information, he can call for your statement of asset and liabilities not more than 3 years older. He can call for the last 3 years data not more than 3 years older. Okay. Now, with the help of this notice, can AO initiate assessment proceeding? No. This notice is just to have a preliminary inquiry. If the AO wants to start with assessment, there are 3 types of assessment under the income tax law. One is 143 subsection 3. If the AO wants to start with a regular assessment, he has to send this regular assessment notice 143.2. If the AO wants to start with best judgment assessment, he has to send this show cause notice under 144. If the AO wants to start with 147, he has to send 148 notice. Moral of the story, with the help of this particular notice, AO cannot initiate the assessment proceeding. For initiating assessment proceeding, he has to send these notices. Okay, let's move ahead with the next power. The next power of the assessing officer is the power to conduct special audit. So, if during the proceedings, if during the assessment proceeding, the AO is of the opinion that assessment is going on, during that the AO is of the opinion that the books of accounts are very complex, the books of accounts are very voluminous, the AO doubts about the correctness of the books of account, there are multiplicity of transactions, there are specialized nature in the books of accounts, and he feels that, he is of the opinion that it is necessary to get in the interest of the department, in the interest of the income tax department, it is necessary to get the accounts audited. So, if he feels that the books of accounts are complex, etc., and if he feels that it is in the interest of the revenue to get the accounts audited, so he will direct the assessee to get the accounts audited with the prior approval of commissioner. He will also take an approval from commissioner, and then he will direct what? He will direct the assessee to get the accounts audited. Will he give an opportunity of being heard to the assessee before getting the books of accounts audited? Yes, he will give an opportunity of being heard to the assessee. Obviously, he will give an opportunity of being heard to the assessee, and then only he will direct the assessee to get the books of accounts audited. Okay. So, the pendency of proceeding is absolutely necessary. Absolutely necessary in Latin phrase is called as sine qua non. Pendency of proceeding is must before you initiate a proceeding under this section. Secondly, opportunity of being heard has to be given to the assessee. If you do not give an opportunity of being heard to the assessee can file a writ petition in the High Court, and the High Court will quash your order of direction under 142(2)(a). So, you have to give him what? Sufficient opportunity of being heard. Next, you have to take a previous approval of commissioner, okay, before giving the direction, or chief commissioner. Plus, who will bear the expenses? All the expenses will be borne by the central government. Audit will be done by chartered accountant, and the expenses will be borne by the government of India. It is not the assessee is going to bear the expenses. Next, what is the time limit to get the special audit conducted? The time limit to get the special audit conducted will be written in the direction given by the AO. It can be 60 days, it can be 90 days, it can be 120 days, somewhere around this. Can I get an extension? Yes, you can get an extension if you make an application. If assessee makes an application, you can get an extension, or even the department can suo moto, AO can suo moto extend also if he feels that there needs to be given more time. But the original time and the extended time, the total time limit should not exceed 180 days from the date on which the direction was issued. So, the maximum time is 180 days. So, the original plus extension, original time is not mentioned in the law, it will be written in the direction. Extended time is also not mentioned in the law, it will be said by the law. But the total time return is written in the law. The total time to be given is written in the law, and the total time to be given cannot be more than 180 days. Check it. Last but not least, once the report is ready, now the AO will use that report in completing the assessment. Will he give an opportunity of being heard to the assessee before using that? Yes. If the AO is doing a regular assessment, he will give an opportunity of being heard. But if the AO is doing a best judgment assessment, he will not give you an opportunity of being heard once again to use that material to complete the assessment. Because AO has to use that material ultimately to complete the assessment now. So, if the AO wants to use that, he can use it without asking if the assessment is a best judgment assessment. But if the assessment is a regular assessment, he has to ask the assessee before using it. Okay. Next power of the assessing officer, that is power of valuation officer, that if the AO while doing the assessment feels that, again, he is of the opinion that there needs to be making the valuation of certain assets, certain properties, certain investments, he can make the reference to the valuation officer. Whether or not he doubts about the correctness of the books of accounts. If he doubts about the correctness of the books of accounts, then also he can give the reference to the assessing to the valuation officer. If he does not doubt about the correctness of the books of accounts, then also he can give a reference to the valuation officer. What valuation officer will do? Valuation officer will ask the assessee first, will give an opportunity of being heard to the assessee, and will ask the relevant information from the assessee to compute the value. If the assessee does not cooperate, then the valuation officer will do the calculation as per the best of his judgment, and then will submit the report to AO as well as to the assessee. Now, what is the time limit to submit the report? It is 6 months from the end of the month in which the reference was made. Once the AO will get the report from the valuation officer, now after this, the AO will complete the assessment based on that report after giving an opportunity of being heard to the assessee. Okay. Now, all these proceedings which I have said you, 142(1), 142(a), 142(2)(a, all of them are going to be faceless in future. Right now it is not faceless, but the government has promised that all of them are going to be faceless in the near future. Okay. Now, next one will go ahead with the scheme of processing of return. What is return? You file income tax return. Income tax return can be filed under any subsections of section 139, or it can also be filed in 142(1), where the AO or prescribed income tax authority send you a notice and then you file the return. Where does the return goes? Return goes to the department. Where is the department? The department is in Bengaluru, and department will process the return. While processing the return, the department, that is software, will process the return and will find out some mistakes. What kind of mistakes software will find out? The software will find out some mistakes and will recompute your total income and total loss. What kind of mistakes the software will identify? First is an arithmetical error. If there is any arithmetical error, software will identify that. Second, if there is some incorrect claim apparent from any information in the return. Sir, what do you mean by this particular phrase? This is a technical phrase. This phrase includes 3 points, 1 point, 2 point, 3 point. So we need to understand these 3 points to understand what is incorrect claim apparent from information in the return. First point is, there is the return, and in which return you are putting one information at 2 places. One information at 2 places in the same return. Return is a very big document of 25-30 pages. One information has to be put at 2 places, but you are putting inconsistently. You are not putting consistently, you are putting inconsistently. For example, in the depreciation schedule it is shown 24 lakhs, but while computing the PGBP income it is showing 30 lakhs. Therefore there is inconsistency and the software will adjust that particular item. Next, there is some information, there is some claim which you have made. Point number 2 says that. This was the example of point number 1, which I have explained to you in class also. Point number 2 says what? There is some claim which you have made, and for that claim you need to substantiate that claim with the help of some information. Like, if you give donation, you have to prove that. If you want the deduction of donation under ATG, you have to prove that who is the donee by giving the PAN of the donee. You are not giving the PAN of the donee, and therefore the software will add back your donation and will disallow the donation and will generate a demand notice and will send you a demand notice, and you have to pay that demand within 30 days. Next, you are claiming deductions, statutory deductions beyond the statutory limits, like house property deduction beyond 30% of standard deduction, like ATC deductions beyond 1,50,000, like ATD deduction beyond 25,000 and 30,000 and 50,000, whatever is the limit for ATD. So in that case, the software will pick up your will pick up your item and will add back your excess deductions. This is what incorrect claim information apparent from any information in the return means. These are the 3 points, 1, 2, 3. Okay. Now later on in Finance Act 2016, government has added few more points over here. That is, if you have claimed, if you have lost in the last year, and if you have filed the return late in the last year, and then also you are claiming the deduction of that loss in the current year, the software will add back that loss, because that loss cannot be carried forward, especially if it is a PGBP or a capital gain loss, that is not allowed to carry forward. Next, if there is some expenditure or there is some income which is disallowed or which is taxable in the tax audit report, but you have not taxed that in your income tax return, so in the income tax audit report it is shown as taxable, it is shown as an expenditure which is disallowed, but in the income tax return you are not showing that. The software will add back that particular item and will generate a demand notice on your behalf. Next, if you have claimed some profit link deductions, even after filing a late return, the software will add back that. Just now I have told you, just sometime before, 10 minutes before, that if you want to claim a profit link deduction, you have to file the return on time. If you do so, if you do not do so, and if you still claim that deduction, the software will add back that. Now, after adding back, the software will give you a 30 days time to reply, and in 30 days, if you reply, well and good. If you do not reply in 30 days, the software will add back that particular item, will send the intimation to you, and will generate notice of demand on your behalf. Sir, will the department send intimation to every person, and if they will send by which date? So first I will tell you the time limit. They will send you within 9 months from the end of the financial year in which the return is filed. Suppose financial year 22-23, return will be filed when? Return will be filed on 31st July 2023 or 31st October 2023 or 30th November 2023. So return is filed in which financial year? 23-24. So within 9 months from the end of 23-24, that will come to 31st December 2024 will be the last date to send the intimation. The time limit over here is to send. They might send you by this date. It may happen that they might send you by 31st December and you receive on 3rd of April, 3rd of Jan. It's all fine, because the laws use the word sending is important by 31st December. Receiving is not important by you by 31st December. You might receive after that also. Will they send in every case? No. They will only send if there is some addition or deletion and there is a demand payable, or if there is a demand refundable, or there is some increase or decrease in loss because of your addition or deletion, or else they are not going to send you the intimation. It is not mandatory to send intimation in every case, but in these 3 cases where there is an adjustment and there is a payable, there is a refundable, there is an increase or decrease in loss, it is mandatory to send notice in that case. It is mandatory to send intimation in that case. What about other cases? In other cases where there is no addition or deletion, the income tax return is clean, the acknowledgement which you have got along with the filing of return, that will be considered to be your deemed intimation. You can keep that in your file. Okay. Next, if I am not satisfied the intimation, what are the remedies available with you? There are 2 remedies which the government gives me if you are not satisfied with the intimation. If you are not satisfied, you can go and file an appeal to CIT appeal, or you can go go for a rectification under 154, but revision under 264 is not possible against intimation. Revision under 264 is denied against intimation. Only appeal and rectification is possible. Can I revise a return after receiving an intimation? The answer is yes. The time limit to file a revised return is 12 and by the end of 31st December or before completion of assessment, whichever is earlier. Receiving an intimation does not mean that your assessment is completed. This is not an assessment. This is just a processing of return, and processing of return is not an assessment. So you can revise your return by what, 31st of December or before completion of assessment. This is not an assessment. Okay. Let's go ahead with our first assessment now, that is scrutiny assessment. For scrutiny assessment to be done under 143 subsection 3, first thing with the AO has to do, or the prescribed income tax authority has to do, has to serve you a scrutiny notice. So by when they will serve you a scrutiny notice? First of all, who will serve you a scrutiny notice? The department says the scrutiny notice can be served by AO or a prescribed income tax authority. Who is a prescribed authority? Assistant Commissioner, Deputy Commissioner, National E-Assessment Center. So Assistant Commissioner or Deputy Commissioner can also send you the notice along with the assessing officer. By when they will send you a notice? The time limit is very, very important. It is within 3 months from the end of the financial year in which the return of income was furnished. So the notice has to be sent within 3 months from the end of the financial year in which the return was furnished. So if the return was furnished in 23-24, so the notice has to be served. It means the assessee should receive the notice. The words used over here is serve, but the words used over here is send. Sending means you should send. Serving means assessee should receive it. There is a great difference between these two words. You need to learn the subject in this manner to understand the nitty-gritties of the subject. Therefore, by 30th of June 2024, you are supposed to serve the notice to the assessee. Now, suppose if the assessee does not receive the notice by 30th of June 2024, what is the obligation of the assessee? Assessee should raise the question immediately that the notice is not served on time. Or if the notice was served on time, but it was served in an improper manner, again the assessee should raise a question immediately that the notice was served on time, but it is not served in a proper manner, proper format, proper design, proper format, proper authentication, etc. Whatever is the requirement of notice to be sent. So if the notice is late or if the notice is improper, the assessee should raise the question immediately. The assessee cannot raise question after completing the assessment. If after completing the assessment, if the assessee started raising the question, the provisions of 292BB will attract. And 292BB says what? If the assessee cooperate in a proceeding and after completion of assessment raise the question that the notice was improper, the notice was not served on time, then he will be precluded from raising such objections in front of the assessing officer. So this is what this provision is all about. Now there is one very important case law also of Lakshman Das Khandelwal, already asked in examination. There was an assessee who was not sent any notice. He was not served any notice. Forget about serving the notice late or forget about serving the notice improper. He was not served only any notice. And then the department passed an order. In that case, department cannot enforce the provisions of 292BB on the assessee. For 292BB to attract, notice has to be served first of all, or it has to be served late. If it is served, it's fine. Even if it is improper, it is fine. But serving of notice is very important if the department wants to take the benefit of 292BB. Without serving the notice, department cannot take the benefit of what? 292BB. That is what this Supreme Court judgment has to say. Now, next, is the notice, is the return, is every return going to be processed under 143(1)? Yes. The department says that every return which is sent to the department at Bengaluru will be processed. Even those returns will be processed which are subject to scrutiny assessment. Yes. Even those returns will be subject to process which are subject to scrutiny assessment. But in that case, the government says that, suppose what happens, suppose if I file a return, I am an assessee, I will file the return. Then what will happen? The department will process the return, will give me the refund. Now after that, the AO will start the assessment. And after that, AO will start the assessment. And I have already got the refund and AO will raise a demand. So now I have to again pay back to the department. So the department says that sometimes the assessee might not pay back. Then it might be very detrimental to the interest of revenue. So in the doubtful cases, the department has said that the law says that as per section 241A, that where the AO feels that giving refund and then getting back the money in the form of demand payable later on will be detrimental, will be very tedious task for the government. So the AO can withhold the refund till the date of assessment with the prior approval of what? Principal Chief Commissioner or Commissioner of Income Tax. So with the reasons recorded. So if the AO feels that giving a refund and then again raising a demand will be very difficult for us to recover the tax, so they can, in doubtful cases, they can what? They can stop the refund at this moment and they can process the return later on along with the completion of assessment and then decide what has to be done. Okay. Next, 143 subsection 3, the first assessment of our life, that is the scrutiny assessment, regular assessment, whatever you will say. AO will do the assessment. AO will take into account all relevant material. Relevant material will come from assessee like ROI, material gathered under 143.2. Relevant material can come from third party also, like special audit report, like valuation report, like SFT, like survey, like summons. You have learned about all of them in different chapters. Okay, none of them are left. All of them are learned in different chapters. So now AO will take into account all relevant material. These are the relevant material which AO might take into account. And after that, AO will pass an order under 143.3. AO will determine your total income, or if there is a loss, then total loss, will determine your tax payable, and if there is a refundable, then refundable. And if there is a tax payable, he will send you a notice of demand along with the income tax order, and along with the notice of demand, if there is a refundable, then he will grant you refund in some days. Okay. Now, there are some provisos. I am coming to that proviso in a while. Before that, can AO do 143.3 without a scrutiny notice? Listen carefully. Three links are related to each other. For 143 assessment, 143.2 notice is necessary, and for 143.2 notice, 139 or 142 return is mandatory. So assessment can be done only if the notice is served, and notice can be served only if the return is filed. All three has to link to each other. Otherwise, the assessment is invalid. Next, there was an assessee whose assessment was going on, and the assessee went to the assessing officer and said that, please give me the deduction of 80G. I forgot to take the deduction of 80G earlier. By making a letter, by making a claim, fresh claim in a plain letter, can the AO allow you a deduction of fresh claim merely on the basis of a letter? The Supreme Court held in the case of Goetz India Limited that the AO does not have the power to give any deduction merely on the basis of plain letter. Tell the assessee to file what? A revised return. Tell the assessee to revise the return, and then accordingly the AO will consider to give that deduction or not to give that deduction. Okay, you cannot give a plain letter to the assessing officer to what? To claim any fresh particular deduction. This power is not there with the assessing officer. This power might be there with the appellate authorities like CIT, appeal, or tribunal. We will see that later on, but this power is not there with the assessing officer. Now, there are certain provisos over here which we need to see one by one. There are certain assessees which are covered under these sections. There are certain assessees which are covered under these sections, and there are certain assessees which are covered under these sections. Let's talk about one by one all of them. These are the assessees which are covered under section 1021. There are 4 assessees whose income is exempt subject to some conditions. But who will check the conditions? The conditions are mentioned in a central government notification. But who will check the condition? The department says that the AO will check the conditions. The AO will check the conditions, and if the AO finds that there is any violation, the AO does not have the power to suo motu disallow the exemption. If the AO finds that there is any violation made by these association, the AO will intimate the central government. Central government will look into the matter, and then central government will intimate the assessing officer, and then assessing officer accordingly can do what? Can disallow the exemption. Moral of the story, the AO cannot disallow the exemption suo motu unless the central government withdraw the exemption, withdraw the approval of this institution. Similarly, these are certain colleges, university, educational institution, and charitable trusts who are registered under different provisions, and if they commit any specified violation, which you have learned in the chapter of what? In the chapter of trust, you have seen that a trust is not supposed to do certain specified violation. If they do certain specified violation, their registration will be cancelled. Okay, so if they do certain specified violation, then the AO don't have to go to central government. AO has to send the reference to principal commissioner. Okay, now though you don't have to go to central government. Here you have to go to central government, but here you have to go to income tax department only, PCID or CID, and you have to make a reference to them to withdraw the registration, and then the AO shall pass an effect to give such withdrawal, and then AO will disallow the exemption. Similarly, here you have to see if the assessee has violated any provision. This is just similar to the first one. If the assessee has violated some provision, then the AO will go to central government, and central government will withdraw the approval, and then accordingly AO will disallow the exemption. So in the first case and in the third case, AO has to go to central government. In the second case, the AO has to go to the principal commissioner of income tax and commissioner of income tax in case of specified violation. In the first and the third case, the conditions are mentioned in specified notifications. In the second case, the conditions are mentioned in specified violation section 1023C and 12AB. You can go and see the chapter of trust we have mentioned over there. Okay, now all these proceedings government says that will now be faceless. About faceless proceedings we will be learning in the later lectures. We will see that in the later lectures, don't worry. Now, next assessment, best judgment assessment. If the assessee fails to do certain things, like if the assessee fails to file a return on time, or fails to write a belated return or revised return or an updated return, or if the assessee fails to comply with a notice under 142.1 or a special audit requirement under 142.2 or a scrutiny notice under 142.2, then the AO will issue a show cause notice to you and will do a best judgment against you. In this case, he will not even issue a show cause notice to you, where he is sending you already a 142(1) notice and you are not replying. But in this case, he will send you a show cause notice. But in the second case, he will not even send you a show cause notice, and he will do the assessment without issuing a show cause notice. He will just send you 142(1) notice, and if you do not reply to that notice, he has the power to do what? To do best judgment assessment against you without issuing a show cause notice. There is one more reason because of which he can do what? Best judgment assessment, which we have learned in PGBP, that if you do not follow 145(1) and 145(2), then as per 145(3), AO has the power to do what? A has the power to do best judgment assessment. Sir, what is 142(1) and 142(2) or 145(1) and 145(2)? 145(1) says that if you are a PGBP or IFOS assessee, then you have to follow either cash system or mercantile system. Whatever you are following, you follow, but you have to follow regularly. You cannot leave it in between, and you cannot change frequently on a year-to-year basis. Plus, 145 subsection 2 says that if you are following mercantile system of accounting, then you have to follow what? Then you have to follow the accounting standards given by the CBDT, that is ICDS. If you violate these two subsections, then the AO has the power to do what? Best judgment against you. This is the fifth reason because of which best judgment assessment can be done. What AO will do in best judgment? He will take into account all the relevant material, and he will determine your tax payable. He will not determine your tax refundable. Under 144, which is for the benefits of the department, 144 is not made for the benefits of the assessee. 144 is made for the benefits of the department, and therefore under 144 you are not going to get any refund. That is not possible. 144 will not grant you refund. If you want refund, your assessment should be done under regular assessment under 143.3, or your return should be processed under 143.1. There you can get refund, but here you cannot get refund. Sir, how an assessment is done under 144? Is it ad hoc basis? No, it's not ad hoc. It's scientific. It's based on some calculation, some logic, and the AO, while passing the order, should also pass a speaking order. Speaking order means the AO should tell us that how he has determined the total income. AO should tell us that how he has determined the total tax. He has to tell us the total income and total tax determination ka process. The entire process has to be written, that he has taken the past returns of the assessee. He has taken the industry average growth of the assessee. He has taken the competitors data of the assessee to compute the total income. It's not a random calculation. Just keep this thing in your mind. Next, 144A, the power of the Joint Commissioner under the income tax law. While the assessment is pending, the case is pending, and the AO, that is, who is the AO? The AC, DC or ITO is the AO. The assessing officer is Assistant Commissioner, Deputy Commissioner or the income tax officer. They are doing the assessment. Now in that case, there is one JC who is observing them all the time. And if the JC feels that they are not doing the assessment properly, the JC can give direction to them. Even the assessing officers can go to JC and ask for the help, that we need help regarding this provision. Please help us. So JC would help us. Even the assessee can go to the JC and tell that we need, the assessing officer is unnecessarily harassing me. Please look into the matter and please help me. So even the assessee can go to the JC and tell to help in the assessment. So the JC can suo moto come into picture. The ACDC or ITO can tell JC, or even assessee can tell JC. Whatever JC will say, that will be binding on the income tax authority, not binding on the assessee. Assessee can file an appeal later on when the AO will pass the final assessment order under 143 or 144, whatever it is. If the assessee wants to file an appeal, assessee can file an appeal. But income tax authority, that is ACDC or ITO, have to follow, they are bound to follow what JC says, because JC is senior to them and they have to follow the directions of their senior. Okay, so this is what this chapter is all about. Let's go about it and then we'll move ahead with the next one. So now let's go ahead with the next topic, and that is the income tax authority and their powers. First of all, let's see the income tax authority hierarchy, which is given under section 116. The topmost income tax authority is CBDT. Below that there is chief CIT, principal chief CIT, and then there is CIT and principal CIT, and at par with the CIT and principal CIT there is CIT appeal. And then there are three rank of assessing officer. JC is rank 1 assessing officer, ACDC is rank 2 assessing officer, and income tax officer is also a income tax assessing officer. So these are rank 1, rank 2, rank 3 JC assessing officer. Generally JC conduct big assessments, like you can say the assessment of GAR, etc. All those big cases will be done by what? Joint Commissioner. Now there are certain powers of income tax authority. Let's see one by one all the powers. The first power is given under 131 subsection 1, that is the power to issue summon. Why are summon issued? Summons are generally issued by civil courts, but that power is also given now by the income tax department to the income tax authorities. So income tax authority may issue summon at any time. Even if there is no proceeding pending, they can issue summon. There is no need to have any proceeding pending to issue summon. Why they will issue summon? They want to discover something, they want to inspect something, they want your attendance in their office, they can enforce your attendance. That is the reason they might issue you a summon. They might compel, they might force you. Compelling means to force you to produce the books of accounts, or they might also issue commission. What do I mean by issuing commission? Let me explain you what do I mean by issuing commission. For example, you are in Bombay. Generally what happens, the issuing commission, all these words are used in reference to Indian Penal Code. But here also it is relevant because this power is also given to Income Tax Authority. Power to issue summon is given under Indian Penal Code, but that power is exactly copy pasted and given to Income Tax Authority also. So what is issuing commission, sir? For example, there is a case which is going in Bombay. So in Bombay, if the case is going on, the Bombay High Court is in the control of that particular case. Now, if the witness is in, say, Delhi, now the Bombay High Court does not have the power to get that person in Bombay High Court, because Bombay High Court does not have jurisdiction on the person who stays in Delhi. So the Bombay High Court has to request to the Delhi High Court that for the purpose of this case, we want this person who resides in your jurisdiction to be present in our court on this date. So Bombay High Court makes a request to Delhi High Court for the presence of that person in our court. This entire process where one court requests to the other court to take the jurisdiction of that person in our case, in our control, that process is known as issuing commission. Okay, so this power is also given to Income Tax Authority now. So Income Tax Authority can also issue commission to get the jurisdiction of other person from other state into our state. Okay, now this power, these four powers are also given in board for advanced ruling topic later on, and it is also given in black money law in paper 6C, which is given in paper 6C. So black money law, if you are outing for paper 6C, you might be knowing for black money law, in black money law also these powers, all these four powers are given to the respective authority over there. Okay, now suppose if the department wants to enforce these powers cross border, that is if they want to issue summon across the country, that is if they want to issue summon to a person who is located in, say, UK or USA, then first of all there has to be a DTAA between India and that country, and in that case the Income Tax Authority will not be an Income Tax Authority below the rank of Assistant Commissioner. So they have put a cap on the Income Tax Authority. In that case the Income Tax Authority has to be at least an Assistant Commissioner of Income Tax or the above authority. Otherwise you cannot call for an information, or you cannot issue summon in cross border cases. Okay, next, can Income Tax Department impound your books of accounts? Yes, why not? They might impound your books of accounts, take in custody for as such period as may they think fit. So they can keep it for as much time as they want, as they think fit. But now there is some restriction. If the assessing officer or assistant director or deputy director wants to impound the books of accounts, first of all, they shall not impound the books of accounts without recording the reasons. It means if these authorities wants to impound the books of accounts, first of all, they have to record the reasons with higher authority. Second, if they want to impound for more than 15 days, only these three, others can impound for without restriction. If they want to impound for more than 15 days, then they have to take an approval from Chief Commissioner or Commissioner of Income Tax. Only then they can impound the books of accounts. Otherwise, they are not allowed to impound the books of accounts. Next, does the Income Tax Authority has the power to call for the information? Yes, they have the power to call for the information under section 133 subsection 6. And who is the power? AO has power, CIT appeal has power, Deputy Commissioner appeal has power, Joint Commissioner has power. What kind of power they have? They can call for an information. From whom? What kind of information? They can send a notice to a firm and they can call for the information of all the partners, their share of profit, their name, their address. They can send a notice to HUF and they can call for all the details of the Karta and the managers and the members of the family, their names and address. They can send notice to trustee, guardian, agent, and they can ask which all assessees trustee you are, which all assessees guardian you are, which all assessees agent you are. We want the details of all of them. They can send a notice to any person and they can ask you to which all people you pay rent, to which all people you pay commission, to which all people you pay interest. For example, they can send me a notice and they can ask me to whom you pay rent, so that they come to know to the person whom I pay rent, whether that person shows his income or not. To whom you pay commission, so that they come to know the person to whom I pay commission, whether that person shows the income or not. Next, they can send a notice to dealer, broker, etc. who are engaged in what? They can send notice to Sher Khan, Zerodha, Ventura Securities, and they can ask for the details and the statements of the names and the address of the persons who are trading in their stock exchange or in their commodity exchange. They can ask for the details of that also. They can send a notice to any person, including banking person, to give such information which may be useful for any proceeding under this act. So this is just to get some information so that they come to know is there anything wrong going on under the income tax law. This proceeding will also be faceless. Now the government has said that. Next point. If they are sending you a notice to call for information, if you are not replying, then they have the power to come and collect that information. They will come during the working hours. They will come only to your business, to your building or place where your business or profession is carried on. So the Income Tax Authority will come to collect the information. They will come to your business hours during working hours at any building or place where your business or profession is carried on. They will not come to your home, and they will ask your proprietor, employees, other person to give certain information. They will not take anything from there. They will only take information. They will not even take your books of accounts under this section. Under this section, they don't have the power to take even books of accounts with them. They only have the power to take information. Now, even this proceeding, the government is saying we are going to do faceless. Now, only God knows how they are going to do this faceless. If they are saying we will come to collect, how they will do faceless to collect? How they will faceless collect? You have to think on it now. I don't know. But let's see. It is not yet in practice. When it will come in practice, this section is not yet in practice. When it will come in practice, we'll come to know how they are going to conduct this faceless. Next. Now the department has some information with themselves. Now they want to just verify the genuineness, authenticity of that information. Okay. So to verify the information in its possession, they may issue you a notice. They may ask you some questions to just verify that the genuineness of the information which they have in their possession. Okay. So this will also be what faceless, as the government has said under section 135A. You can check it once. Okay. So let's go ahead with the next section, which is very important for your exams also. That is power of survey. The power of survey is given to the income tax authority. And who are the income tax authority to whom the power of survey is given? It is given to Principal Commissioner of Income Tax, Commissioner of Income Tax, Principal Director of Income Tax, Director of Income Tax, Joint Commissioner, Joint Director, Additional Director, Deputy Director, Assessing Officer, and Tax Recovery Officer. These are the officers to whom the government has given the power to do survey. Apart from that, the survey is also given as a power to what? To the Inspector of Income Tax. But the Inspector of Income Tax has limited power, does not have absolute power. What kind of power they have? They only have the power of inspection of books of accounts or other documents, placing marks of identification, etc., or making copies, etc. therefrom. Okay, they don't have any power apart from that. Now, both these authorities should be subordinate to what? Subordinate to these higher authorities, and they have to take an approval with the higher authority. Without that, survey is impossible. So there are around 7-8 authorities over here who have absolute power. The income tax officer, that is inspector, has limited powers. Whether it is these absolute authorities or whether this is inspector, all of them have to take an approval from what? These 4 authorities, that is Principal Director General of Income Tax or Director General of Income Tax or Principal Chief Commissioner of Income Tax or Chief Commissioner of Income Tax. So they have to take an approval from these authorities. Okay. So now once they have taken the approval, they can do the survey. Where they will do the survey? They will do survey at business place, at professional place, or even at charitable activity place. Even at your charitable trust place, they can do survey at that also. And when they will enter the place, they will enter the place only after sunrise but before sunset. They will enter the survey place only after sunrise but before sunset. But there is an exception whereby which says that if the business hours is in night, then they can enter for survey in the night also. So if the business hours is in the night, then they can enter the survey in the night also. There is no harm in that. Okay. Next, what they will do over there at the business place, at the charitable activity place, at the profession place, what they will do? They will search for books of accounts. So they will only enter business place or profession place or charitable activity place? No, they can come to your home also if the books of accounts are kept at home. If the books of accounts are kept at some other place, then they have the power to go to that place also, and the power is not restricted to only business place, profession place or charitable activity place. Okay. Now, what they will ask? They will ask the proprietor, the employee or other person to inspect the books of account, that we want to inspect the books of accounts. You want to check your cash account, we want to check your stock account, we want to check your various valuable articles, we want some other useful information from you all. Okay. Apart from that, they also come for a survey to check the compliance of TDS and TCS, whether the assessee is complying with the TDS and TCS provisions or not, whether they are deducting TDS timely or not, whether they are paying TDS timely or not. So whether they are filing quarterly returns of TDS or not, TCS or not, they do survey for the purpose of identifying this also. Okay. Now apart from that, income tax authority may do many other things, like they may place marks of identification in your books of accounts or other documents and copies of it. They may also impound your books of accounts, retain it. They may make a list of the cash account. They may make the list of the stock which is available with you. They may also verify, they may also make a list of various other articles which are verified by them. They will record the statement of any person, but under any circumstance they cannot remove from your place any cash, any stock, any valuable article. Yes, but if they want, they can remove books of accounts and other documents. So in survey, they can only take away from you books of accounts and documents. They cannot take away any other article from you, including stock. It is not allowed. Only books of accounts is allowed. Can they do survey in case of ceremonies, events, functions also? Yes, considering the nature and the scale of the transaction, how big the transaction is, how big the event is, they can do survey in the case of a functions, event, marriage ceremony, etc., etc., etc. also, if you don't cooperate, they will issue summon under 131, if you don't cooperate with that also, they will authorize search and seizure against you, and they will do a raid under the income tax law. Search and seizure is nothing but a raid under the income tax law. Okay. Next. Power to inspect registrar of company. Now, if the officer, the assessing officer, wants to inspect the registrar of company to see the list of shareholders, to see the list of debenture holders, to see the list of bankers, so can he do so? Yes. Under section 134, it is allowed. The AO, joint commissioner or CIT appeal, or any person subordinate to him in writing on his behalf, as the case may be, may take copies of any registrar of member, debenture holder, etc. And this proceeding will also become now what? It will be faceless. Next. Very important section. Provisional attachment of any property. Can a assessing officer provisionally attach your property? What do I mean by provisionally attachment? It means the property cannot be sold by the assessee. It can be used by the assessee, but it cannot be sold by the assessee. So can the department provisionally attach? Yes, the AO has the power to provisionally attach your property in case your assessment proceeding is pending. In case your assessment proceeding is pending. So he can attach a property only if the assessment proceeding is pending. He can attach in case of penalty proceedings also, but only in case of one penalty proceeding which is covered under 271 AAD, which we will be seeing later on. That too, the penalty should not exceed 2 crore rupees. So he will attach your property in case of what? Your assessment proceeding is pending, or even in case of penalty proceeding, but only one penalty proceeding is covered as of now, 271 AAD, which where that too if the penalty amount exceeds 2 crore rupees. So he may, in order in writing, provisionally attach your property in the interest of the revenue, and this attachment of property will be done after taking approval from Chief Commissioner or Commissioner, and that too it will remain effective only for a period of 6 months from the date of passing of order of such attachment. Once 6 months have gone, the attachment will cease to have any effect. Okay. Now, next, there are some Finance Act 2022 amendments which I would like to tell you all. The first Finance Act 2022 amendment over here is CBDT under section 119 subsection 2 clause A has lot of powers to give you lot of relief. Like they can relieve you under 139, they can relieve you under 234A, 234B, 234C. So in that they have made one addition, and that is 234F. So now if the CBDT wants, they can relieve you from fee which is paid under 234F, which is of 5,000 rupees and 1,000 rupees under certain special circumstances. Okay. Next is the Supreme Court judgment which talks about a very important principle of law. Can CBDT amend a law by passing a circular? No. CBDT does not have the power to pass a law by just giving a circular. If they want to amend any law, they have to amend the law in the parliament. They have to follow the parliamentary procedure. They cannot amend any law just by giving what? A circular. That is not allowed. Okay. Last but not least of the, in this chapter, that is, suppose an assessee was not able to file the return of income, and the reason was beyond the control of the assessee. So beyond the control of the assessee, if the assessee is not able to file the return, can the department consider his case and condone his delay? And the answer is yes. Check it please. So let's go ahead with the next power, which is one of the biggest power under the income tax law, and that is the power of search and seizure. Now, where is the power of search and seizure given? It is given in section 132. Now, the first thing which we need to understand over here, who has the power to issue search warrants? Because to exercise the power of search and seizure, one has to issue search warrant. So, who has the power to issue search warrant? Who can authorize search and seizure? It is 8 income tax authority who can authorize search and seizure. Out of that, 4 income tax authority have absolute power, and the remaining 4 income tax authorities should get empowered from CBDT. So, who are the 4 authorities who have absolute power? Listen, Director General, Director, Chief Commissioner and Commissioner. These 4 have absolute power to authorize search and seizure. And the remaining 4 which I am saying will be empowered by CBDT. Only then they will get the power to issue what? Warrant. That is Additional Director, Additional Commissioner, Joint Director, Joint Commissioner. These 4 authorities should be empowered by CBDT. So, these are the 8 authorities who have the power to issue what? Warrant under search and seizure. Now, why they will issue search and seizure warrant? When search and seizure warrant will be issued by them? When search and seizure will be authorized by them? If the income tax authority have information in their possession, and with the help of that information, they have reason to believe that the assessee has failed to comply with section 131 summon or section 142 notice. If the income tax authority has the information in their possession which give them reason to believe that the assessee has not complied with 131 or 142, or the assessee might not comply with 131 or 142, or the assessee is found to be in possession of some bullion, jewelry, valuable article which represents what? Undisclosed income. So, if any of the 3 points are happening, then the department has the power to issue what? The search and seizure warrant. Can department disclose the reason to believe with anyone? The court has held that, and even the income tax law says that the reason to believe should not be disclosed with any person or authority or with any tribunal also, Because if one start to reveal the reason to believe, then there will be a lot of problem to the person who has informed to the income tax department. For example, if I have informed the income tax department that you have got the undisclosed money, and after the search and seizure is over, if department start to disclose my name in public that he is an informer, then the things won't work in future. My life will be threatened because of this act of the department. Therefore, the department should not disclose the name of the person who has given the reason to believe. They should not disclose that to any person, any authority, or even to any tribunal. Okay, that is not allowed, absolutely not allowed. You have to keep this information very, very, very secret. Okay. Next one, what are the powers of an authorized officer? Once an assessing officer will get the warrant, after that the officer will be called as an authorized officer. And what are the powers of an authorized officer? He can enter and search any building, any place, any vessel, any vehicle, any aircraft where he has reason to suspect that books of accounts, money, bullion, jewelry, etc. is kept. He can even break open the lock of any door, almari, etc. if the keys are not available. He can search any person who is going inside the building, who is coming outside the building, who is already inside the building. He can do all these things. He can ask the person who is in control of the electronic records to support him to open the electronic record. It means if the accountant is in the support of the accountant is in the control of electronic record, then he can ask the accountant to give the passwords, etc. Next, he can seize any books of accounts, documents, bullion, jewelry, assets, everything except stock in trade. Except stock in trade, he can seize everything. Then the next power is same as which was there in the survey also. He can place marks of identification, make copies, etc. All those things are allowed, etc. Okay. So these are some of the major powers which are given to the authorized officer under the income tax law. Next. What are the press release given for gold jewelry? How much gold can be kept by a person? Listen carefully. If you have gold from explained sources, then there is no limit. You can keep 10,000 kg also if it is from explained sources. But if it is from unexplained sources, the government has given some minimum exemption to keep the gold. Till that much gold, they are not going to ask any question. If the gold is beyond that much limit, beyond the limit which is set by the government, then they will start to raise the question on the SSE. So, for married lady, it is 500 gram. For unmarried lady, it is 250 gram. And for male member, whether married or unmarried, it is 100 gram. Up to this much limit, they are not going to raise any question on you. Whether your gold matches with your income or whether it does not match with your income, this much is an exemption which is given to every citizen in this country. But in reality, if your capacity is more, if there is a custom and tradition to keep more gold, then depending upon the facts and the circumstance, depending upon your family customs and tradition, even higher quantity of gold can be exempted by the officer. That depends upon facts and circumstance of every case. Suppose you are Mukesh Ambani, suppose you are Ratan Tata, suppose you are, for example, Infosys family, then obviously this limits looks very small for you. So the government can give you a higher limit in that case. Okay. Next. Proviso to section 132(1). What does it say? It says that if the officer cannot seize any item, any article, because it is very dangerous. Say for example, it's a chemical item, or suppose it is a very big crane, it is very voluminous, it is very weight. Therefore, if the officer is not able to seize any item because it is very voluminous, very big, very physical characteristic is very dangerous, then in that case, the concept of deemed seizure will come into picture. Example can be considered as what? You are going to seize a crane, a bulldozer, it is very voluminous. You are going to seize a chemical company, etc. It is dangerous in physical characteristic. Therefore, you can tell the officer or the person who is in possession that take this order and you are not allowed to use this or otherwise deal with it or sell it unless with the officer's permission. Unless I give you permission, you are not supposed to remove it from here. You cannot remove this bulldozer. You cannot use this bulldozer. You cannot use the chemicals which are kept in your company unless I give you what? A permission. And this seizure will be called as a deemed seizure. Again, the concept of deemed seizure will not apply on what? Stock in trade, because stock in trade, even normal seizure was not applicable. So the question of deemed seizure does not apply over here also. Okay. Now next one is order of restraint. Now what do I mean by order of restraint? Order of restraint is not a seizure. First of all, let me tell you, 132 subsection 3 is not a seizure. Here the department is coming to your home or office, they are looking at some items and they are having a doubt whether this belongs to you or not. They don't have complete idea also it belongs to you or not. Suppose the department has come to your home, and when the department went to your bedroom, the officers went to your bedroom, they did not find anything. So they went to your brother's bedroom. So in your brother's bedroom, they found some jewelry. And when they ask you that whose jewelry it is, your brother said it is my jewelry. And he showed the relevant documents also. But still the department was having some doubt in their mind that whether the jewelry is brother's jewelry or assessee jewelry. So the department gave a order of restraint in the hands of the brother. The department said that to the brother, we are giving you an order of restraint. We are not seizing your jewelry, but we are just restraining you to sell this particular jewelry for a period of next 60 days. Check. And this order remain effective only for a period of 60 days. After 60 days, this order is ceased to be effective. Okay. So it is not a seizure. It is just a restriction for some time. Next, jurisdiction of CIT. Now, what does this jurisdiction of CIT has to say? Suppose there is a Bombay CIT and there is a property in Bombay, and the Bombay CIT feels that, the Mumbai CIT feels that there is something wrong in the property in Mumbai, but he cannot do a search and seizure authorization for that property because the assessee resides in Delhi. Because the assessee resides in Delhi. The assessee resides in Delhi, the commissioner is in Mumbai, the property is also in Mumbai. So now the Bombay CIT has to take an approval from Delhi CIT, and then only he can do search and seizure in Mumbai property, because the property comes in his jurisdiction, but the assessee does not come in his jurisdiction. So in that case, what will happen? He has to take an approval from Delhi CIT, and then accordingly he will do what? Search and seizure in Mumbai property. In that case, there will be a lot of delay in taking approval, and if there is a delay in taking approval from Delhi CIT and then going for the search and seizure in Mumbai, so therefore the government said that if delay in getting the approval will be detrimental to the interest of revenue, if delay in taking the approval will be prejudicial to the interest of revenue, in that case the Mumbai CIT has absolute power to authorize search and seizure in the Mumbai property, and accordingly they can search and seize the Mumbai property and take the items in their control. Okay, check it please. So let's go ahead with the next point. There are some key notes which are mentioned over here, which we need to understand one by one. The first key note says that, can the officer take the help of a police officer? Yes, definitely. He can take the officer of a police officer. He can take the officer of any other central government officer, or both. So both can also help the assessing officer to do the search and seizure, because that might be dangerous for his health also, for his security also. Because sometimes what happens, the assessing officer is trying to do the search and seizure, and in revolt, in against of that, the assessee tries to attack to the assessing officer. So for that purpose, for the purpose of safety, the officer has to take the help of any police officer, officer of central government, or both. Okay, let's go ahead. Now, the AO may take an examination on oath of any person that we have done search and seizure and we are taking all these things from you, etc., etc., etc. These are something which are very simple point. Okay. Now, next one is a very, very important point. Presumptions in the course of search and seizure. Once an authorized officer comes for a search and seizure, there are certain presumptions that he will by default make. What are the presumptions? That is, if he finds something in your hand, he will say that that belongs to you. Whether you are an employer or whether you are an employee, whether you are any other person, if he finds something in your possession, he will say that it belongs to you. Second, he will say that the contents of the books of accounts are true. By default, the contents of the books of accounts, document, etc. will be considered to be true. Plus, if you are found to be handling any documents or any particular sheet or any particular paper in which there is something written, then it will be said that it is in your handwriting. You have done the stamping, you have done the attestation, everything is done by you. So if something is found in your possession, first of all, it belongs to you. It is, the content is true and everything is done by you. You have written it, you have stamped it, you have attested it, everything is done by you. Okay. Next, valuation during the search. Now, during the search, the AO will find out a lot of properties. He will find out a lot of bullion, jewelry, silver, gold, etc. Now, he need to value that. So, can he take the help of a valuation officer? Why not? He can take the help of a valuation officer under section 142A, and the valuation officer which is mentioned in 142A will help the assessing officer to quantify the wealth. What is the amount of wealth that the assessee possesses? And he will give a report here at a very faster rate, that is in 60 days. Because in 142A, the officer takes generally 6 months to give the report. But here the officer will give the report just in 60 days. Okay. Next, provisional attachment. Can the assessing officer provisionally attach your property? Yes. The department can provisionally attach your property, because what happens generally, first search happens, then seizure of property happens, and then the department will send you a notice to do an assessment under 147. Then 147 assessment will be done, which will be seen in the next revision video, which is there in the next chapter. Okay. So therefore, the department foresee that there might be huge amount of tax liability which might be coming in assessee's case. And if the assessee will start to sell the property, from where the hell we will recover the tax liability? So department says what? We want to attach your properties. We want to attach your building. We want to attach your car. We want to attach your bullion, jewelry, cash, etc. So that you should not sell it or put underneath. Therefore, in that case, what happens? The department has been given the power to what? To go for provisional attachment. And this provisional attachment, they can go during the course of search, when the search is going on, or within 60 days from the date of search. In either of the case, they can go, and it will remain effective for a period of 6 months. And you have to take approval. The officer has to take approval from Principal Director General, Director General, Principal Director, and Director, as the case may be. Okay. Next, During the search and seizure, the department will seize your books of accounts. Now, how long they will keep the books of accounts? Now, the department says that once the search and seizure is completed and once the assessment is completed, after that, within 30 days, we are going to give you your books back. So, once the assessment is completed, after that, within 30 days, they are going to give your books back. Okay, this is the first thing. Now, second thing, what if they do not, what if the officer needs even after that? When, sir? The books of accounts are needed even after the assessment is completed. Why he will be needing? By default, when the assessment is completed, after 30 days, within 30 days after the assessment is completed, you have to return the books, documents, etc. Valuable article, etc. Whatever is the documents, etc. You have to return it back. What if the officer require even after that? If the officer require even after that, say for imposing the penalty on the assessee or for imposing the prosecution on the assessee, then the department can withhold the books even after 30 days from the end of the assessment. But in that case, they have to take an approval from higher authority and they can retain even beyond that. So beyond that, till when? When the next proceeding is completed. Suppose when the penalty proceeding is also completed. Now, after that, within 30 days, they have to give it back. So first, they have to give it back within 30 days after the assessment is completed. Now, after that also, if they want, they can keep it till the completion of penalty proceeding. And once the penalty proceeding is completed, they have to return it back after the penalty proceedings are completed. Okay. Next, in the meanwhile, till the time the books of accounts are there with the income tax department, in the meanwhile, if the assessee requires books of accounts, then what will happen? Will the department give us the books of accounts? Yes, why not? The department will give us the books of accounts, but they will give you in the form of a copy. The officer will tell you the time, the officer will tell you the place, come to that place at that time, and you can take the photocopy, Xerox copy, whatever you say, and they will give you the Xerox copy of that particular document. Don't worry about it. Next. Suppose there is a search in my home or in my office, and in my office there is some bullion, jewelry, valuable article found in of my friend's name. So department asked me, whose bullion is it? Whose jewelry is it? Whose valuable article is it? I said it is not mine, it is my friend's. So what my assessing officer is going to do? My assessing officer will hand over all those things to the relevant assessing officer of my friend within 60 days. That is what the role of my assessing officer is. My assessing officer cannot get into all these things and he cannot start the assessment of my friend because he does not have jurisdiction on my friend. So in my premise, while doing the search, if the officer finds something else belonging to some other person, he can take into possession and give it to the relevant assessing officer within 60 days as per 132(9)(a). Okay. Next, suppose there is a particular assessee who is hiding some incomes, who is hiding some bullion, jewelry, valuable article, but the department feels that it doesn't make sense to do search and seizure. Why? Because there is already a search and seizure which is done by some other laws, like FEMA people have already done, like prevention of money laundering of people have already done, like custom law all have already done the search and they have seized everything. In that case, what will happen? In that case, the Commissioner of Income Tax or Director General will tell the assessing officer that you can go and request the relevant law officers, you can request the FEMA officers, you can request the PMLA officers, you can request the custom officer, you can request the GST officer that if they don't require the money, bullion, jewelry any longer, they can hand over all those things to us, and then we will be requisitioning that office, that asset, that books of account, that money, that bullion, and then we will do the search and seizure assessment on the assessee. So if the search and seizure is already done by some other law, then the department cannot do anything. They can only request. That activity is known as requisitioning for books of accounts, documents, bullion, jewelry, etc. So in that case, you become what? A requisitioning officer, and you are not an assessing officer or authorized officer, because now you are only officer who is allowed to do what? To make a request to the other laws to get the documents in your possession. Okay. Next is very important point. 132B is the last thing for today's revision lecture. We'll continue the revision of the next chapter in the next discussion. Okay, because this topic is slightly heavy topic, that entire procedure of assessment, 143, 144, then the power of income tax authority, then search and seizure. All these things are slightly heavy discussions. It takes time to discuss and even to teach here at my end. Now, once the department has seized the asset, how they are going to recover the tax and which taxes they are going to recover out of it. So they can recover your existing income tax liability out of your seized asset. They can recover your wealth tax liability out of your seized asset. They can recover your gift tax liability out of your seized asset. They can recover all these things. Apart from that, there will be an assessment which will be done on you. So they will recover that liability also. That is the new assessment. That is 147 assessment will be done after search and seizure is completed. So that whatever liability comes in that search and seizure assessment, that will also be recovered out of the seized asset. Plus they will also recover penalty and interest. They will also recover penalty and interest on your taxes. Plus, will your existing liability include advance tax liability also? No. The government has said that the existing liability will not include the advance tax liability. Don't worry about it. Okay. Now next, this proviso is extremely important for exam. The institute has asked this proviso a lot of times. Suppose today is say 15th March 2023 and today is the date on which the search has happened in my office, and the department has seized say 10 crore rupees from my office. Now the department gives me an opportunity that says that if within 30 days from the end of this month, today is 15th March, today is the day on which they have seized 10 crore rupees from my office, and now they are giving me an opportunity that within 30 days from the end of this month, that is till 30th April 2023, if I go to the officer and explain the nature and source of this 10 crore rupees, that from where I have got this, on the date of search, that is on 15th of March, I was not able to explain. I was very panicked. I was very shocked. I was very thrilled. I was not able to explain. There was no words coming out of my mouth. But the government is giving you 30 days from the end of the month. That is till 30th April 2023, for example. So you have to go till 30th April 2023, that's 30 days from the end of the month, and go and explain the nature and source of the income from where you have got this asset. If you explain that, they will recover the existing liability, and they will whatever is the existing liability over here, they will recover that, and balance they will release it to you. Suppose the existing liability is 3 crore rupees. So they will recover 3 crore and balance 7 crore. They will give you back. They will give you back with the approval of commissioner or chief commissioner, and that will be given back to you within 120 days from the completion of search. Don't worry about it. So you have to go to the officer and explain within 30 days from the end of the month, and then they will give you your assets back after reducing the existing liability. Okay. Last but not least, how will the government discharge the liability? If the department has seized your cash also, department has seized your assets also, the first they will recover the money from cash, that is money, that is from Rokra, hard cash, and if the hard cash is not sufficient, they will sell your assets and discharge the liability. Okay. And after that, whatever is left, suppose they have recovered 10 crore from you. So out of that 10 crore, 4 crore is cash, 6 crore is asset. So first they will recover tax liability from 4 crore cash. Then 6 crore asset will be sold, and after that, if some amount is left, they will return you back. And if they don't return you on time, then the department will pay you 0.5% interest per month, because they also don't have right to keep an excess asset with them, which is not going to be used for what? Payment of tax liability. So if something which is recovered already and still some assets are left, some money is left, you have to return it back to the assessee, because that is something which you are unnecessarily holding with you. So if you are unnecessarily holding, department is also liable to pay interest at the rate of 0.5% per month or part thereof. Okay. So this is what this search and seizure is all about, and the topics which we have covered in this revision videos are assessment of various entities, then return filing provisions, all the assessment procedure sections, then comes the income tax authority powers, and then the biggest power, that is search and seizure. Okay, I hope you all have enjoyed the lectures. The next revision video will come soon. Don't worry about it. We'll try to upload at an earlier. Bye all of you. Take care.